What if you could turn $10,000 into over $30,000 or even $50,000 with MGK or VGT? Today, we explore two giants in the investment world, MGK and the Vanguard Mega Cap Growth Fund. Let's delve into the realm of exchange-traded funds, focusing particularly on MGK and VGT. We're comparing these titans not just for the thrill of the matchup, but to illuminate the paths of investment growth. Understanding where and how your money grows is crucial in making informed investment decisions. Stay tuned as we dive deeper into the numbers that matter. Remember to watch till the end to show you a higher value fund that has almost half the expense ratio as MGK. Every investor knows that the devil is in the details. Let's break down the basics of MGK and VGT. First up, expense ratios. These are critical as they directly eat into your potential gains. The Vanguard Mega Cap Growth Fund, or MGK, boasts a low expense ratio of 0.07%. On the other hand, VGT has an expense ratio of 0.1%. While these numbers might seem small, over time, even a tiny difference can significantly affect the total returns of an investment. Now let's talk about the compound annual growth rate, or CAGR. MGK has an annualized return of 15.64%, which is quite robust. However, VGT outshines with a CAGR of 20.15%. This higher rate can lead to a much larger end balance over an extended period. For instance, starting with $10,000, VGT's superior growth rate could yield a significantly higher end balance compared to MGK. With MGK and VGT's impressive growth, it's clear why they're popular. But how do they handle market volatility? Investing isn't just about the good times, it's also about weathering the storms. Let's dive into the rollercoaster years of MGK and the Vanguard Mega Cap Growth Fund, better known as VGT. Both funds have seen their share of exhilarating highs and daunting lows, which are key to understanding their overall performance. For MGK, the best year boasted a staggering 51.67% gain, a remarkable peak that highlights the potential for significant growth. However, the fund's worst year saw a sharp decline of 33.59%, underlining the volatility and risk inherent in the market. Switching gears to VGT, this fund's best year slightly outperformed MGK, with a 52.65% increase. Its worst year, however, was less severe, with a decrease of 29.70%, showcasing a slightly more resilient performance during market downturns. These fluctuations are critical for investors to consider, emphasizing the necessity of robust risk management strategies in safeguarding investments. MGK and the Vanguard Mega Cap Growth Fund have their highs and lows. Let's see how this impacts their risk ratios. How do MGK and VGT stand up to risk? Let's crunch some numbers. To understand investment risk and performance, two key metrics come into play: the Sharpe Ratio and the Sortino Ratio. Both ratios help investors evaluate the risk-adjusted returns of their portfolios, but they focus on different aspects of risk. The Sharpe Ratio considers how much excess return you are receiving for the extra volatility that you endure holding a riskier asset. A higher Sharpe Ratio is typically better, indicating more return per unit of risk. In our case, MGK stands at 0.8, while VGT is slightly higher at 0.95, suggesting that VGT provides better return for the risk taken. On the other hand, the Sortino Ratio differentiates harmful volatility from total overall volatility by focusing only on the downside or negative volatility. MGK's Sortino Ratio is 1.31, whereas VGT leads again with a Sortino Ratio of 1.62, indicating it has a better performance concerning downside risks. Understanding these metrics can significantly impact your investment choices. Now, how do MGK and VGT correlate with the broader market? Knowing how your investments move in relation to the market is crucial. Let's explore. When we dive into the world of investments like MGK and the Vanguard Mega Cap Growth Fund, it's important to understand how closely these funds follow broader market movements. This is known as benchmark correlation. MGK shows a benchmark correlation of 94%, while VGT is slightly lower at 92%. Why does this matter? Well, a higher benchmark correlation means that the fund's performance is more aligned with the overall market trends. For investors who prefer predictability and want their investments to mirror the broader economic environment, a fund like MGK with its closer correlation, might seem more appealing. Now let's quickly recap what we've covered about these two giants. Starting with the expense ratios, MGK stands at a lean 0.07%, which is slightly lower than VGT's 0.1%. In terms of compound annual growth rate, VGT leads with 20.15% compared to MGK's 15.64%. We've seen the volatility each fund can exhibit in their best and worst years, alongside their respective risk-adjusted returns measured by Sharpe and Sortino ratios. And of course, the benchmark correlation we just discussed is crucial for understanding how these funds perform in tandem with the broader market. Whether you lean towards MGK or the Vanguard Mega Cap Growth Fund, understanding these elements ensures a more informed investment decision. Armed with these insights, making a choice between MGK and VGT just got a bit easier. When deciding between MGK and the Vanguard Mega Cap Growth Fund, it's crucial to align the choice with personal risk tolerance and investment goals. Every investor has a unique profile. Some might prefer the slightly lower risk and consistent returns of MGK, with its lower standard deviation and stable growth pattern. Others might lean towards VGT, drawn by its higher annualized return and potential for significant gains, despite its slightly higher volatility. Remember, both funds offer considerable opportunities for growth, but understanding the nuances of each can profoundly impact long-term investment outcomes. It's not just about picking a fund, it's about making an informed decision that complements one's financial landscape and future aspirations. The promise I made in the beginning is that I'd share with you a higher performing and less expensive alternative to MGK, and that is SCHG with an expense ratio of 0.04% and FSPGX at 0.035% expense ratio. They both have similar returns to MGK when you put them in the portfolio visualizer. An alternative to VGT with a lower expense ratio is FTech, although its returns slightly lag greater than the difference between their expense ratios. Here's to making smart, growth-focused investment choices.